Hello, my name is Regine Thomas, and I am conducting my finance project report on the Destination Excel Group Incorporated and the Buckle Incorporated. So, my abstract is as follows. This due point analysis project is dedicated to analyze the financial ratios and accounting measures of Destination Excel Group and the Buckle Incorporated Group for the fiscal year 2015 to 2019. The ratios and the accounting measures are computed to determine the financial position of the company. These ratios are ascertained by using the data from the financial statements of the companies and the information available on the market platforms. The various financial statements are studied thoroughly to determine the past and current financial performance in the company. So the company introduction, I'm going to start with Destination Excel Group. It deals in the retail sale of plus size clothing for men. There are over 300 stores of the company in the United States. The company also sells through electronic mode from its website, so you can go online, not just in store. Its headquarters is situated in Canton, Massachusetts. The common stock of Destination Excel is listed in the NASDAQ Global Market. The founders of the group are Calvin Margolis and Stanley Berger, who started the company in the year 1976. The company employs around 3,000 to 5,000 employees in its various stores and the corporate office. Introducing the Buckle Incorporated. It operates in the fashion retail industry and sells apparel, accessories, and footwear for adults as well as children. There are about 451 stores of the company throughout the country. The company was first established in the year 1948 in Kearney, Nebraska by David Hirschfeld under the name Mills Clothing. There are about 2,800 employees working in the company. The official corporate website of the company was launched in 1999. The common stock of the Buckle was first listed in the NASDAQ in 1992 under the symbol BKLE and later shifted to the New York Stock Exchange, where it currently trades as BKE. The company ratio analysis. The ratio analysis of the company is conducted by computing the financial ratios under various categories such as liquidity, profitability, efficiency, leverage, and market value ratios, and interpreting the ratios as to what the different ratios indicate about the financial position of the company. The ratios are compared on a time series basis, analyzing the ratios with the previous years, and also on a cross-section basis, comparing the performance with an industry competitor. The period for which the financial ratios are compared is 2015 to 2019, and the cross-section analysis is done by the Buckle Incorporated. And I have a picture of a graph of the liquidity ratios. The liquidity ratios identify the ability of a company to pay current short-term dues without the requirement to obtain a loan from external sources. The company should have sufficient amount of liquid assets to continue its operating activities in the short run. The current ratio, quick ratio, and cash ratio defines the liquidity position of a company. The current ratio should be at least 1 to qualify as a favorable condition for the company's liquidity position. The current ratio of DXLG, which is Destination Excel, is more than 1 in the initial 4 years and less than 1 in the year 2019. The quick ratio and the cash ratio is less than 1, and both the ratios increase in the middle years and then decreases in the end. All three of the ratios of DXLG are less than the ratios of BKE, which shows that the liquidity position of BKE Buckle is better than Destination Excel. I also have a graph showing the efficiency ratios, and the efficiency ratios is a measure of the effectiveness in the utilization of the assets invested by a company and the efficient management of its liabilities. Day sales outstanding measures the ability of a company to manage its receivables collection efficiently. The DSO of Destination Excel is between 3 to 5 days in all the 5 years, but the DSO of Buckle is lesser than that of Destination Excel. This indicates that the company collects its receivables quickly. Inventory turnover ratio of Destination Excel increases from 1.98 times in the year of 2015 to 2.58 times in the year 2019. But the ITO of Buckle is more than Destination Excel in all the years, which means that it sells inventory more number of times than Destination. Production cycle of destination decreases from 184 days in 2015 to 142 days in the year 2019, but is more than buckle in all the years, which indicates that destination takes more number of days than buckle to sell the inventory in hand. Accounts receivable turnover of destination fluctuates between 75 times to 126 times, but is less than the ratio of buckle, which means that buckle is more efficient in collecting its receivables. Average collection period of buckle is also less than destination in the years of 2016, 2017, and 2019. Accounts payable turnover ratios of destination is between 7 and 8 times, while the ratio of buckle is between 17 and 19 times, which means that the latter pays its short-term bills more frequently than destination. Average payment cycle of destination is more than buckle, which is an indicator of more number of days taken by destination to pay short-term dues than buckle. The cash conversion cycle of destination is more than buckle, but is on a decreasing trend. This shows that buckle converts its inventory into sales faster than destination. Sales to working capital ratio is increasing on a year-to-year basis from 2015 to 2018, but becomes negative in the year 2019. This ratio is lower for buckle in the initial 4 years and higher in the last year. A higher ratio is favorable, which means that destination requires lower funds to generate the same level of sales as that of buckle. Capital intensity ratio of destination is more than buckle in the year 2015 and 2016, but less in another period, which means that it requires lesser amounts of assets to generate the same amount of sales than buckle in later years. The total asset turnover of destination is also lower than buckle in the first 2 years, and higher than buckle in the later years, which indicates that destination is generating more sales on its assets than buckle. Then we have leverage ratios, which I also have a graph in here as well. A leverage ratio measures the financial health of a firm by assessing the amount of debt it has on its balance sheet. Higher the amount of debt, the more vulnerable the company is to become insolvent. Debt ratio measures the amount of debt funds funded by assets. The debt ratio of destination decreases from 67% to the year 2015 to 85% in the year 2019 and is higher than buckle in all the years, which means that a considerable portion of debt is financed by assets for destination. Cash coverage ratio measures the ability of a firm to meet its interest expenses with the available cash balance. Higher ratio is considered better. Destination has a cash coverage ratio between 3 and 10 times across all the years in question. Buckle does not have any high interest obligations, so this ratio is not applicable for this company. The equity ratio of destination is less than buckle, which indicates that destination uses more debt than equity to finance its assets. Debt equity ratio is an indicator of the portion of the company financed by debt rather than equity. Higher ratio is unfavorable. The debt equity ratio of destination is increasing on a year-to-year basis, which means that its debt levels are increasing. Buckle does not have a long-term liabilities from the year 2015 to 2018, so this ratio cannot be calculated in the year 2019. It is higher than destination. Leverage ratio measures the portion of debt in the total liabilities section of the balance sheet. Destination and Buckle's debt portion is increasing on a yearly basis, but Buckle has a lower debt level than destination. Time interest earned ratio helps in ascertaining the probability of defaulting in payment of debt obligations. Destination has a negative TIE, which means that it has more chances of defaulting. Buckle has no interest payments, so this ratio is not applicable. Equity multiplier ratio is higher for destination and lower for Buckle, which means that Buckle has lower financial leverage than destination. I also have the profitability ratios sheet. The profitability ratios are computed to determine the profitability of a company in comparison with its past results as well as its competitors. Total profit margin measures the gross profit earned from each dollar of sales. The gross profit is decreasing with the increasing period of debt for destination, but is higher than Buckle in all the years. Operating profit margin is negative for destination in all the years except 2017, which means that its operating expenses are on a higher scale, which resulted in a negative profit. Buckle's operating profit is much higher than destination, which indicates better control on operating expenses. Net profit margin is negative for destination all the years and between 9 to 13% for Buckle. This shows that interest expense of destination is on a higher scale. Operating income return on assets measures the operating income earned on assets. This ratio is also negative for destination and positive for Buckle. Return on total assets and return on common equity is negative for destination, which means the company is not earning sufficient returns on its assets and its equity. Both ratios are positive for Buckle, but decreasing within the passing year. We also have the market value ratios, and they are as follows. I have the sheet here as well. On the sheet, I'm able to convert that market value ratios are useful for investment decisions in the companies. It helps to ascertain whether the share of the public company is overpriced, underpriced, or at par with the market price. Price earning ratios measures our worth of the stock in comparison for its earning capacity. P&E ratio of destination is negative in all the years, while it is between 9 to 12 times for Buckle. This shows that Buckle will have positive growth in the future than destination. Price earnings and growth ratio for destination is decreasing within the increasing year, which indicates that the stock has higher chance of being undervalued in the future. Buckle has a negative PEG ratio in the last 3 years. Market to book value ratio compares the price of the stock to its book value by dividing market valuation with its book value. This ratio is higher for Buckle and lower for destination, which shows that the stock of Buckle is expensive than that of destination. Dividend is not paid by destination all 5 years. Therefore, dividend payout ratio and dividend yield ratio is not applicable for the company. Growth rate of earnings is negative for the company. We have accounting measures. Also here, the total net operating capital in this total of the operating working capital and the operating non-working capital. Destination's net operating capital increased drastically in the year 2019, which is a good sign, but the amount is less than Buckle in all the years. Net operating working capital for Destination is on a decreasing trend in the later years and becomes negative in the year 2019 due to higher current liabilities. Buckle has a much higher working capital than Destination. Gross investment and working capital is the amount of the current assets invested in the business. The current assets are also decreasing in the later years for Destination and almost half of Buckle's current assets. Net operating profit after taxes measures the amount of profit before deducting the interest expense but after deducting the tax amount. This amount is negative for Destination in all the years except 2016, but Buckle has far better NOPAT than Destination. Free cash flow is the amount of operating cash flow left after reducing the amount of capital expenditure. Free cash flows are positive for Destination but less than Buckle, which means that Destination has spent a considerable portion of capital expenditure. Operating cash flows are cash flows that are determined after adjusting the non-cash expenditures and incomes and current assets and liabilities from the net income. This cash flow is positive for Destination but decreasing every year for Buckle, has almost 10 times more than cash flows than Destination. Return on investment capital is negative for Destination all the years except 2016, and Buckle have higher returns than Destination. Market value added in this amount of market capitalization left after adjusting the shareholders' equity. This value is positive but decreasing on a higher rate and becomes negative in the last year. Economic added value added measures the financial health of a company on the basis of residual NOPAT after deducting the cost of capital. Economic value added is negative for Destination and positive for Buckle in all 5 years. So the conclusion is, in this Dew Point research project, several types of ratios are studied and analyzed individually to determine the liquidity, efficiency, leverage, profitability, and market value position of the company, and also comparing its performance with its industry competitor to ascertain the company's financial standing in the market. Liquidity ratios are both companies indicate that Buckle has a better liquidity position than Destination in all 5 years. The performance of the efficiency ratios was average for Destination, and Buckle was more efficient in utilizing its assets to generate less sales, although the day sales outstanding, sales to work capital ratio, and total asset turnover ratio is better for Destination than Buckle. The leverage ratios of Destination indicate poor financial health of the company in comparison with Buckle. The debt ratio, debt equity ratio, and equity ratio shows that the company is heavily dependent on external finances to carry out the operations of the business in the long run, which imposes higher risk on the stability of the business. All the profitability ratios are negative for Destination except total profit margin. This indicates that the company is not able to generate profits on its sales and assets. Market value ratios of destination indicates that the stock of destination is undervalued and its market to book value ratio is less than 2.5. The price earnings ratio is negative for destination, which is not a good sign and it indicates negative growth in the future. Dividend is not paid by the company since 5 years. After detailed financial ratio analysis, it can be concluded that the financial position of the Buckle Incorporated is better than the Destination XL Group in all aspects of measurement. Destination XL needs to improve its operating profits and reduce its interest liability as well as the debt levels on its balance sheet. It should consider funding the business with more equity than debt, which will reduce the risk of insolvency in the future. Also, the management of receivables should be done properly to avoid tying the funds with the creditors.